Welcome to TheoTRADE. This is Don Kaufman. It's February 21st, 2025. Just about 20 minutes to go to the cash close here on this Friday afternoon. And what a Friday it is. First of all, it's an options expiration. It's the monthly expiration. It's a big, what we term OpEx. Approximately $2.7 trillion are coming off the books. That basically means expiring options, approximately $2.7 trillion, proverbial crap load of gamma risk. Look, the bottom line, we're back in the box. What does that mean? Yeah, we're back. We're back, baby. Back in the volatility box. I'm going to break down quite a bit for you here in terms of the volatility that we're seeing right now. Well, that and much more here, of course, on this TheoTRADE weekend update. Right down to business. You know, to start here in the S&P is pretty much out of the gate this morning. We saw some sell-side activity right now. A little perspective. We're only down 1.7%. I say only. You realize it's pretty nominal. You know, the larger scheme of things, it looks like a lot when the S&P's, but still my heart, they're down 100 handles. You know, I don't know, 18 minutes to go to the close. It could get a lot worse. Could get a lot worse out there because, as I said, there's just a proverbial crap load of gamma risk leaning on this marketplace. You know, but I'd rather not look at the S&Ps to begin with. I'd rather look at the SPX because here is an important point to be made. This week, which was a 4-day trading week, really we didn't do anything until today. Basically on Tuesday, it's like for the most part massively unchanged. What'd you have on Wednesday? A little bit of a bid, coming into Thursday, we sold off, we rallied back up, did a little dance, made a little love. But here we are on this Friday, some big sell side activity. The most important thing about the sell side activity though today is that we actually cracked below, and it's not over yet, but we cracked below the lower edge of the SPX expected move. So it's kind of like, that's a big deal. It's a big deal because at that point it becomes like a bit more of an unruly kind of move. But as I said to you, now about 15, 16 minutes to go, it ain't over. That lower edge is somewhere right around 60, kind of 42, and here we are trading 60-16, and there's a hell of a lot of volatility. From where I sit, at least right now, it looks like we're going to go for it and close towards lows, but hey, the higher probability is to always come back to the edge of the expected move. Nevertheless, that is quite a big deal, because what it's actually displaying is that the volatility that we're presently seeing, again, is a little bit unruly at this point in time. And, people are looking for headlines and so forth. And there's a lot of headlines out, everything from the administration to news about coronavirus out of China. Push it all aside. I'm serious. Nothing, that we're hearing had anything to do with that. Look, as I was pointing out, the market was already seeing sell side activity, before this. And there was some sell side activity, of course, even like consumer sentiment survey, the Michigan Consumer Sentiment Survey set off a tirade of volatility. So everybody's always looking for the answer. Oh, what's the catalyst? What's the catalyst? I'm going to tell you exactly what it was. Okay. It's a combination of the OpEx, that's the option expiration, coupled with the volatility box. The bottom line is I've been talking about these levels incessantly. Every single time I do a video, whether it's, a weekend update, a Wednesday night video, whatever, this is the levels that matter. And we're going to box it in right now. Literally, freezing the screen and going to show you here. This is the level that I'm talking about to get ultra specific. The levels that I even detailed back in the box basically means 61.11. Now you can see that we traded to 61.50, and I talked about last weekend, a pop to the upside before a magnificent drop. That's literally what I've been kind of calling for. And that pop above 61.50, that was something. You get above 61.50 and we could have gone parabolic to the upside. Instead, though, we dropped right back into that volatility box. And in doing so, I've said this time and again, and people, I don't think they really grasp kind of what I am alluding to here. Once you're in this box, It doesn't matter whether you're trading at 6111 or 5900. It's the exact same thing. And you go, well, no, it's not. That's ridiculous. It's 200-point difference. No, it absolutely is. All you're doing inside of this box is just pinging back and forth. Okay. So we've dropped quite precipitously back into the box. Where are we right now? We're pretty much dead smack between that 5900, okay, and roughly the 6100, right? Trading 60.28. So unquestionably, like, now you got to be a little concerned, coming into next week, probably, at some point going to probably touch down to that 5900. And then the only thing that really matters, and when I say it doesn't, it doesn't matter where the upper edge of the box, the lower edge of the box, I'll tell you why it doesn't matter. Okay, here's really what it comes down to. It doesn't matter until we actually breach. We breach lower, we breach higher. That's all that matters. And that's why I said when we got up here to 61, 66, yeah, then I'm paying attention, because at that point we can go parabolic and just explode. And it didn't happen. Instead, we broke to the upside and then cracked lower. That is critically important. So what are we looking at next week? I'm going to tell you again exactly what we're looking for, because these levels, right? The levels aren't necessarily telling you which direction we're going to go, but again, I would look for 5,900 may make an appearance next week, which seems like extreme. But it's only 130 points away, which is almost inside of next week's expected move, right? So you're 130 points away, but there's a pretty good probability we're going to touch very close to 5,900. When is it really going to matter? It's going to matter if we start actually piercing through 5,900, because then kind of a trap door opens. That, people, would be critically important. Now, the reason I'm saying, and I'm leaning to the downside right now, for the first time in a very long time, bonds. Let's talk about bonds for a moment. Bonds reacted to sell-side activity. Bonds, historically speaking, okay, have been used as a little bit of a duck and cover. It's kind of like when there's big selling out there, big waves, big selling. What do? You duck and cover and go into the bond market. So a lot of people don't understand is that on the professional side of trade, if you have a few $1 billion under management, you can't go to cash. There is no cash. There is no tomorrow. No, there's no cash, right? So when I say there's no cash, banks like, hey, let me sell, $20 billion of securities and then just put it in a, the weekend account over there. It doesn't work like that. So they have to actually rotate. Okay. And what you're seeing right now is a very classic rotation, and it's out of S&Ps. And again, it's a little bit alarming because it's out of S&Ps into the bond market. But the bond market today was being bought as duck and cover. So that is notable. That, clearly I am paying attention, because the bonds are indicating by their little rally here. It's a small rally, but it's a real rally based on sell side activity. The bonds are indicating, okay, that equity risk is real. When I say equity risk, like going out there and owning Microsoft right now, that risk is real, and it's spectacular, right? That the risk is becoming and starting to really permeate into markets is real. That's what the bonds are indicating. Now, let's take it a step further. At a time like this, you got to look at volatility. And of course, everybody likes to look at VIX. So I'll start with VIX just to humor all of you. But in the VIX, it hasn't even hit 20. So basically, the VIX has been taking like a dirt nap lately, down and around 15. And I'm actually long VIX. I'm long a bunch of in-the-money VIX calls, and they're starting to see degrees of profitability. They're up about 18%. But degrees of profitability in VIX. But the truth is, the volatility is just lifting its head up off the mat, but it hasn't gone parabolic. Let's not get crazy. The volatility hasn't soared. We're not even above 20. And I just wanted to give you perspective on that one, because people are going to tune in and be like, holy crap, the market got killed today. It's not getting killed, right? We're down, but we're not getting killed. To further that, take a look at the volatility futures. Now, this is where I do some big homework. The volatility futures, okay, are still in contango. Contango. What does contango mean? Contango basically means, okay, that March is still below April, okay, is still below May. But we've tightened up a little bit. We're about 40 cents away from going into backwardation, okay? Now, if we're to touch down to close to 5,900, yeah, that's going to change things a lot. This is much more important, okay, than most people make it out to be. And the reason it's so important to understand that if March exceeds, let's say March jumps to like 1920, and then the April only goes to like, 19, for instance, like even, I'm just, for example, so this one is March and then this one is April. So if that actually occurs, that's actually what we construe as backwardation. It changes the way that dealers being market makers, would mitigate risk. A lot of dealers are also short March and kind of long April. That trade has been going on for years. But like a calendar spread inside of volatility futures. Nevertheless, okay, we're not in backwardation. So the bottom line is like no one's freaking out over here. So vol futures are not in backwardation, not yet anyway. It would take a lot more than like, I mean, look, what you really have here is one day of some sell side activity, and that's it. As I said to you guys earlier in the week, there's a lot of bullish hubris going on. I'm not sure why there's a lot of bullish hubris. What if you hit all-time high? Okay. Yeah, you hit an all-time high, you hit an all-time high, you hit an all-time high. Third time's the charm. It's a triple top. I know that's what you're looking at, but who knows? Okay. The bottom line is you're back in the box. Okay. The next thing I want to talk about is you'll note that in a time of heavier volatility, I don't talk about individual stocks. Who cares? Individual stocks like, oh no, but still my heart, Caterpillar is selling off. Okay. Oh no. Okay. Look, it doesn't really matter. I think it's interesting that, stuff like Microsoft, I find it interesting. I was talking about this last weekend. Microsoft is basically very like close to lows. Okay. Stuff like in Tesla's actually really close to lows and like recent lows, and Google is actually cracking into some new low territory over here. Okay. Amazon, this thing took a real hit today. Some new low territory. It hasn't been this low since, effectively back here in the beginning of December. So there's a little bit of damage being inflicted, not in Apple. Okay. It's the impervious Apple. But the point being, I don't really care about individual products because you know what matters to me? When there's big selling, okay, big selling, nobody cares about anything except correlation. Like when you're seeing a bigger sell-off and the S&Ps are down 100 handles and they're starting to approach almost a 2% loss. Oh no, the only thing that really matters is correlation. And I'm going to tell you exactly why. Correlation. In this particular case, it's not there. The correlation is not present. And if it's not present, first thing, you're nowhere near capitulation. What's capitulation? That's when you've puked your guts out and you've capitulated and rolled over. Correlation, we haven't even gotten close to it. Correlation would be like 95 products trading to the downside, like 5 up. You have 30 other products here that haven't been sold today. There's actually a lot of pockets of strength, and you're actually still seeing rotations. We're rotating into biotech, like look, buy toothpaste, that's Colgate Palmolive, okay? Buy Pfizer, they're buying drugs. Buy Philip Morris, we're smoking, we're drinking, and apparently we're buying drugs here, and buying food too. But the point is, Kraft Heinz, there's still, okay, very specific and very detailed rotations going on. That's not a positive in my opinion, that's a negative. It's a negative because when you're seeing sell side activity, you'll want to see greater degrees of capitulation because greater degrees of capitulation, greater degrees of correlation, okay, are how our markets turn around and finally rebound. Yeah, we're not there yet. And that is one of the reasons where I refuse, like I can talk about sectors as a whole. For example, like if you look at sectors over here, not just Meta, but if you look at sectors, you look at like the S&Ps. Oh, the S&Ps are outside their expected move. What did the NASDAQ do though this week? Okay, where's the NASDAQ? The irony is the NASDAQ kind of in line with what the S&Ps did. They're just mildly outside the expected move. But the NASDAQ is not exactly getting pummeled in trade. But I digress. Like again, stop focusing so much on individual stocks. You got to pull your head up, all right, out of the sand when there's volatility, and you'll start to look at the aggregate. You start to look at the S&Ps and these major levels, because that's the crap that matters. Because I'm going to tell you right now, I don't care what stock you are in. If it's in the S&P like 500, okay, this is the bigger takeaway here is I don't care what stock you're in. If it's in the S&P 500, if the S&Ps break 5,900, it's on. You're going to see sell side activity. I don't care what underlying you're in. They're going to sell them all. And that's the key point. Okay. They're not going to hit one. They're not going to hit two. They're going to hit them all. That's what you look for. That's why I say correlation is not present, which indicates there's no capitulation. All right. Let's talk about some trades. You know, this week, a lot of stuff that I had that was way out of the money. Okay. There's one of my favorite ones to talk about. I had a trade on, still have a trade on JP Morgan. Okay. JP Morgan. Look at this. Look at this little monster with 2 minutes to go to the cash close. This thing was way out of the money. Okay. We are so close to winner chicken dinner on this JP Morgan trade. I actually pulled off my short and Meta. Okay. Winner chicken dinner in that one. And again, I'm just going through a couple trades. So JP Morgan's right on the dance floor for a 55% close and made money on Meta. But the big one that I hit, ladies and gentlemen, the SPX. Oh, we hit one. Let me just tighten this up to the last like 7 days. Okay. I went out and actually purchased an SPX butterfly when, okay, on Tuesday for 50 cents. We sold that thing for $3 today. It's a 500% return on that one. And this morning, everybody's like, it's going to expire worthless. You suck. Right up until the point we made 500%. Yes, I do. All right. Last, but definitely not least, when we're talking about the SPX, well, wouldn't be complete without actually talking about the expected move. So the expected move this week was $72. And what's so crazy about today's trading session, we started today's session literally unchanged on the week. We were massively unchanged in the week. Where are we right now? Outside the expected move. And we are officially going to close outside the expected move. So this OpX has brought quite a bit of risk back to the marketplace. But let's not talk about the past. Let's talk about the future. What is the future? Well, 7 days from now, what's the expected move? And here, oh, look at the irony here. Okay. You have right now, and it's not settled yet, about $114 expected move slated for next week, approximately $114 expected move. Why is that so interesting? It's interesting because if you take a look at the S&Ps, what level was I just talking about? Right around 5,900. The real level is literally like 5,911. And we're about 115 points off of that. So, ladies and gentlemen, things are, they're going to get interesting in this next week of trade. Look, set aside what you think about individual underlyings. Set aside like even the calendar. Because you're like, oh, this is coming in. Oh no, there's ECB minutes coming. Like people are all hopped up about some of the data that's coming out. Relax. Don't worry about the data. Worry about the volatility that's right in front of you. Relax. Don't worry about the next tweet. Worry about the volatility that is right in front of you. Because ladies and gentlemen, as I said, we are so very back in the volatility box. This is Don Kaufman. Have a wonderful weekend. Bye-bye.